is what you need to know about the chart, what you need to understand. When you see a candlestick, what are they? So now we have different type of candlesticks. We have different type of charts. Not candlesticks. We have different type of charts. We have the line chart. We have the bar chart, or we have the candlestick chart. So let me explain. Let me show what a line chart is, right? So for a line chart, you have a straight line. That's the y-axis, and you have another straight line, which is the x-axis. Right. So we have the y-axis and the x-axis. On the y-axis, this is where you show your price. Y-axis is where you see your price. And I'm just setting up my table now. This is my board. I want to use this for the board today. So y-axis is where you set up a price. The x-axis is where you set up your. And what do you have on timestamp? You have the time and the date. So it's where you have the timestamp. And timestamp typifies the time and the date. So you understand what this is, right? And on every chart, either a Bitcoin chart, crypto chart, stock chart, FX chart, bond, wherever, you're going to have this. The price section, the y-axis defines the price, and the x-axis defines the timestamp. And basically what it does is redraw the line. So like I said, basically psychology has to do with understanding what the chart is saying when you understand psychology. And like I said, if you followed any of my class, I've been saying that whenever you see on the candlesticks, talks about the human psychology, it's sentiments and emotions. That is what indicates whatever you see on the chart, either you're seeing a green or the red. It indicates human emotions. So, and for you to be able to trade, if you understand that your candlestick in the chart is all about human emotions, then it's best for you to understand the emotions, what the candlestick is telling you, because the information, you can't really know everybody's emotion, you can't really know what everybody's thinking. But the chart has actually helped us to understand and collectively put everybody's emotion into play and put them into a chart. So if you understand what the chart is saying, then you understand what the market is saying. Then you can really get to understand the possible direction. Like I said, possible direction. There's no certainty in trading. There's no certainty in market. There's only probability. But when you have a better understanding of the human psychology, that will actually help you to make better decision, and making a better decision will give you better outputs in terms of your predictions. That will actually be able to help you to make better decisions. I mean, be able to you have higher probability in making good trade. So starting with line chart, like I said, we have three different type of charts. We have the line chart, we have the bar chart, and we have the candlestick chart. Whatever is on the line chart indicates the closing price of any chart, right? So if you have a chart that is like this, you have a chart like this. So let's say this is our chart, right? So whatever you see here, this is the closing price. Let's say we are using a daily time frame. And one of the major things that you need to understand whenever you're trading is the time frame. You know, if you have ever asked me which coin to buy, if you notice, the first question I normally ask you is, how long do you want to trade it for? How long do you want to hold it? That is because the time frame is very, very important. The time frame matters a lot. So if you're going to, before you say you want to do any analysis, or you want to check a chart, or you want to buy any coin, the first thing is you should know how long you want to hold it. So understanding how long you want to hold it will actually help you analyze your chart based on the time frame. So let's say for this chart, I'm going to be using daily time frame. So the beginning of the day, and I think in a new candle is always open in Nigeria. If you're in Nigeria, a new candle is always open. The new candle is always open by around 1 a.m. in the morning. That's when a new candlestick gets. That's when the new candle on the new market opens in Nigeria, right? Around 1 a.m. if you're using the Nigeria new candlestick chart. That's GMT plus 1. So let's say at 1 o'clock, the market closes at this price. At another 1 o'clock, the next day, we have a close around this region. So, like I said, line. Where's our color? Like I said, the line chart shows you your closing prices. Okay, line chart shows closing price only. And now, like if you're going to be using line chart to trade, it doesn't show you sufficient information. That is why the Japanese actually came up with the bar chart. So basically, this is what you need to know about the line chart is the closing price. So you can easily use that to know, okay, you have a price closing at this range. If you're going to use this, I normally do not use this for analysis. If you're going to use it, you probably get to look at, okay, are we having you get to check if you're having convergence or divergence based on the time frame. But it doesn't really show you it doesn't tell you what's exactly between the beginning of the day and the end of the day. You won't get that in a line chart. That is why it's best for you to either use a bar chart or a candlestick chart. So let's go to what a bar chart is, right? So like I said, line chart only show closing price. For a bar chart shows what we call the open price, the closing price, the open price, the high price, the low price, and the closing price. I'm sure you'll probably have seen something like this on any of the charts if you're trading, let's say Binance. You'll have seen OHSC or OLCH, something like that. O means opening price, H means the highest price, L means the lowest price, and C means the closing price. Okay, so let me just closing price. So whenever this actually is what you need to look out for. This information actually tells you, depending on the type of candlestick that is formed, it tells you what the psychology of the market is. So let's give an example of a bar chart right now. So we have, this is a bar. Now we have the closing, we have the opening. Let's say we have an opening here and the price closed here. So we have, let's say the price opened here and the price closed there. And this, if the price opening here and the price closed, then this is going to be it's going to be a bearish candle. It is going to be a bearish candle. What is it? Okay, so what I'm trying to say here is we have open price. Let's say the price opened at $1,000, open 1,000, and closes at 900. So that is, and now you say we have open, we have close. But here, if the price open here and the price went up, I mean, you're still having a candlestick here and you're having another one below it. Whatever we have below or above, anything you have below or above your opening or closing price is what we call the shadow. We call them the shadow wick or tail. So whatever you have above your opening price and your close price is what we call the shadow wick or tail. They also add their implication. I'm going to explain them because of the class. Now, what happened here is the price actually started at 1,000, right? Can you hear me, please? Let me know if you can hear me.
Yeah, I can hear you.
Okay. So the price opened at 1,000 and went up. The price opened at 1,000 and went up to, it came up to around 1,200, right? And got rejected. That is the price. The buyers, that is the bull. Now, if either I'm using bull or the buy or buy, let me just type that out. What am I saying? So y bear equals to BS or seller. So either if you hear me say bull, it means buyers. If you hear me say bear, it means sellers. So let's say the bulls are the one that started, the buyers are the one that started, right? They kick off from here. The buyers kick off from here at 1,000, and they were able to pump the price. We have more buyers, and the price went up to $1,200. Now the price got to $1,200, and at this $1,200 is where the sellers realized that, okay, this market is already oversaturated, and they start rejecting. Okay, they start rejecting the price, and the price now start coming downward. We opened here, it went as high as 1,002 and got rejected, and now the price now start coming down. Now, as the price start coming down, the price got to let's say it goes to 800, right? So this is the high. This is our H high. This is our low. 800 is our low. So we have the high is the highest price for that day. For example, this is the daily chart. The highest price for that day is 1,002. The lowest price for the day is 800. Now, the same thing that happened here. The price got to 800, that which is the lowest, and got rejected again. But before and it got rejected probably close to the end of the day, and the price later closed at 900. That is why we now have this as our closing price. Okay, the same thing. The reverse also happens for the buyer, for bulls, right? This is a bear candle. So let's have an example of a bull candle. What will a bull candle look like? A bull candle is going to have the body, right? Then we have the opening price and the closing price. So we have, let me fill it. So let's say the bull started from here, which is at 900. The price, price started at 900 and closed at 1,000. The same thing happened. Our high is like 1,200, and our low is 800. So how did it happen? So the price actually, this is our opening price. This is our opening price. This is our closing price. This is our high. And this is our low. Okay, so we have the opening price, which is 900. This is what happened that day. Is we have the bulls actually are the ones in control. In this scenario, the bears are the one that for that day the bears were in control. For this scenario, the bulls are in control. Don't forget what I'm talking about is bar chart. This is a bar chart. This is a line chart. Okay, so we have the bull started the day. The bull actually started here at 900, But during the day, the market, when the price went down, the bear took, for some time, the bear took over and they took the price to a low of 800. But the bull were stronger than the bears. And they finally took the price from 800 to 1,002. Even though the bears also they tried to fight the market and tried to reject it, and ended up rejecting it at 1,000 closing price. That means to say the bulls are stronger that day than the bears. Bar chart. That is bar chart for you. So understanding this psychology actually helps you to know the reason why we're having those candlesticks, the reason why we have the color, the reason why the color is like that. Now let's go to about candlestick charts. What does candlestick chart looks like? The body. So here, what we have, where the one that actually shows the color is what we call the body, and above you can either add it above or below. Is what we call the wick. Now the same thing, like this is your wick. Like I said, we have the shadow, wick, or tail. This is your wick. This is your shadow or tail. You can call it whatever. And this is the body. Now, the body can either be green or can either be red. When it's red, it means the bulls. When it's green, it means the bulls are in control. That means the buyers are in control. When it's red, it means the sellers are in control. So let's change this. So now for this same scenario we have there, I'm going to represent this what we have here on this sell price. So what happened here is we have this line typifies it shows our opening price. So this is our opening price. The price opens here at let's say it opens at 1,000 and the price closed here. This is the high price. Okay, we have the open, we have the high. This is our high price, that is H. The price opens and goes to 1,300. That's the highest price, right? And now the price is before the end of the day, the price ended up closing at let's say 800. That's the close. Now for here, what we have here, our close is equal to our low. That means closing price is also equal to the low price. If you realize on this, the candle I drew here, there's no wick or shadow below the low. So our closing is equal to our low. So whenever you have our closing equal to low, then this is the way this is what it's going to look like. Okay, so we have, and because this happened, the color of the chart is going to be red. The wick, this is the opening price, this is the closing price, this is our high. Our closing price equals to our low price. So these are scenarios we can have. Let me type it out. Scenarios we can have is open can be equal to high. So I'm going to explain the implications of this as well. Open can be close equals to low. Then we have close equals to high. And we have open equals to low. Okay, these are the scenarios we can have. So we have open equals to high. For what we have right now, close equals to low. So we are currently on scenario 2. Close equals to low. For this one, close equals to low. Now the other one we can have is open equals to high. For open equals to high, then we get to have a scenario like this. Okay, so we have our open. The price opens here. Okay, yeah, it's basically the same thing. This is open, and this is our high. So we have this open is also high, which is at 1,000. Our close and closed here. Now this is our low. So if you have something like this, that indicates that the market is actually the market is what? Bearish. I mean, the price of that day is bearish. So when you have the high price, the highest price of that day is the closing price of the day is lower than the highest price of the day, you're going to have a red candle. So right now we have open equals to high. Okay. So this is a bearish day. But for us to have a bullish day, so like I said, I'm going to be talking. I'm basically breaking down everything you need to know about candlesticks, and because if you understand this, it's really help. Sorry, I want to clear this. So let's talk about the scenario for close equals to high, right? Where close equals to high, there's a possibility of you actually getting the close equals to high, right? So we have the opening. The opening price of the day is let's say we have the open at 800. Price opened at 800. It's the lowest price of that day is 700, and the price got to an high of an high of 1,200. That same high is also your close. So in this scenario, what we get to have is a green candle. That is a bullish day. Okay, you can also have it in such a way that you're weak. You know, right now we have our low is what I just explained here is the close equal to high. Now we can also have open equals to low. That is, we can have our wick to be above instead of it being below. So we have this is the body. You have the wick. So we have our what? Opening. Opening equals to low. This is our opening price at let's say at 800 plus 700, which is also our lowest price. And we have closing price, let's say at 1,000. Then the highest price of that day is 1,200. So this candle is going to this is actually an indication of a bullish candle. So if it's a bullish candle, it's meant to be green. Okay, it's going to be green. So understanding these things actually help you understand market psychology. That is what actually happens. What is the implication of this, right? Like I said, I'm going to explain what they all mean, right? bullish. Now, one of the things you want to look out for is the strength of the body and the strength of the wick. When you say candlestick chart and the body is longer, like when you say the body is thicker and longer than the wick, this is a bullish candle, also telling me that the body is longer than the wick. That's an indication that the bulls are in control for that day. If the body is weak, like what we have here is a longer body, a shorter wick. That is, the bulls are usually in control. That the possibility of the next candle being green or bullish, the possibility of the price going upward is kind of high. That's the implication. And when you have another candle that has if the same thing happens on your bearish candle, that is the bear chart or the sell chart, is indicating that the price of the market going upward, the potential of the market going upward is going downward is very, very high. Okay, now that doesn't really determine the price is going to go up or down. Now that is where we have the shape of different candles. Like, okay, what if we have a candlestick that has can someone tell me what this indicates? If you have a candlestick that has, from what I just explained, that has a long wick and the body is let's put it to green. Let's put it to green, right? Or red. Let's put it to red. If this occur, okay, if we have this candlestick and this occur at the top of an uptrend. Now, what I mean is the top of an uptrend. Okay, I'm going to clear this side. So can somebody tell me what the implication of this candle? Let's say you have an uptrend, right? You have the price going up. The chart is actually going up, and at the top of the uptrend, you have this kind of candle, either green or red. You have this kind of candle with a long wick. What's the implication? What does it mean? Red. What's the potential implication? This is not a certainty, but what does it mean? Can somebody just tell me what you think it will mean? Hello?
I think that's a slight price rejection.
Price rejection, yeah. Good. So it's actually a possible price rejection. Yeah, I can hear you. Thank you. Thank you for the input. It will actually possibly indicate a potential price rejection, but it doesn't confirm a price rejection. It only indicates a possible price rejection. Why did I say it indicates? That is, we have the price has been going up, and close to the end, this is not the end of the uptrend, right? It doesn't indicate that this is the end of the uptrend. But when you see this kind of candle, when we have a long wick or a long shadow, and the body is low, this is what we call an inverted hammer. Okay, this is what we call an inverted. It can either have a wick. Sorry. An evening star. Now, it can either have a wick or not. Either it has a wick below it, it probably a small wick below it or not. It doesn't matter. As long as it's showing something like this, if you look at what we're having here, we're having a longer wick at the top. That is, what happened here is the price opened here. If it is a green, let me fill it with a green, right? So if it's a green, what actually telling us is that the price opened here. We have our open price here. The price, this is our low. The price came down this low. and the price now went as high as this. This is our highest price. But the price came down and got rejected. That is, the price kept going upward until it got, where the bulls are in control until they got here, until they got to this price. Now the sellers are like, no, this price, this is like this most saturated point. The price for the day is saturated, so it can't really go beyond that price. Then it starts getting rejected. And what you get to have here are what we call the market orders. Those are the market makers. They actually setting market orders to ensure that the price keep coming down. So the price ended up closing here. So we have open here. The price went down as low as here, rejected and went upward as high as here, and got rejected again. So the price closed at the end of the day here. Now, what the implication of this is that the fact that we have the week longer than, let's say this is a daily time frame, right? We have the week or the shadow is longer than the body, is indicating that, and is longer than the body, and the candle closes at green. It's closed as a green. That is telling you that the bears are in control. But at the end of the day, the bear were not able to close, were not able to finish the race. That is why we are having a green. It's just like football match, right? We have, let's say we are having, okay, who's playing today? We have, is it Man City and Chelsea that is playing today? Or Liverpool? Right? So we have them starting at the, so we have, let's say Man City and Chelsea is playing, right? So Man City is the bears, right? And Chelsea is the bull. Now, at the beginning of the game, Chelsea started. Don't worry, like I said, Chelsea is the bull. Chelsea is the bull. That's green. Man City is red. Right? These are the bears. So at the beginning of I'm just explaining this candle. At the beginning of the day, at the beginning of the match, Chelsea actually started playing. Let's play Chelsea well. Anyway, at the beginning of the match, Chelsea started playing here. This is the open price, right? They had control. Chelsea was in control. They had good possession, right? They were in control, and close to the end of the match, let's say they already winning. And for the first half, they're already winning. Now, second half, Man City took over. Let's say they already had 5-0. So at the end of by second half, the Man City actually took over and they started winning. They started scoring 5-1, 5-2, and started coming down. But at the close of that match, Man City was not able to overtake or equalize with Chelsea. That is why we have this green candle. That is why it's showing green. If we have this our opening price, and this is our highest price and closing price. Do you understand what it means, right? So, and that's when putting football match aside, coming back to trading charts. If there is sell volume, we have large sell volume that's already indicating that this price is going down. The peers are actually having enough volume to put the price downward. But at the end of the day, they were not able to close the price in red zone. As they are not able to push it below the opening price. They were not able to close the price below the opening price. There is a high potential that they are going to continue the downtrend until the liquidity finishes. Do you understand what I just explained? Because if you don't understand, let me go over it again. Okay? Do you understand what I just explained? Hello?
Yeah, I understand you.
Yeah, good. So what I'm trying to say is at the end of that day, the bears were not able to overtake the bulls. That is why we have green. But that doesn't mean, because of the longer week is an indication that the bears can still continue a downtrend. Note the word can still continue a downtrend. Okay? So, and the potential of them continuing a downtrend is because of this longer week. We have this is a pushback. This is a pushback for the price, that the price is actually going to high. the next candle might possibly be a red candle. So if you are going to enter this market, when you have a candle that's closing around here, if I'm going to make let's say I'm trading futures. Futures means, I don't know, is everybody familiar with futures trading or forex trading? You know, in futures trading, you can also make money when the price is going down. Okay, I think we might have somebody. Hello, sir. Do you understand? Are you familiar with what we call futures trading or forex trading? Dr. Mukherjee, are you there, sir? So, are you familiar with what we call with forex trading or futures trading?
Hello?
Hello, sir. Can you hear me?
You're asking you have idea of the forex trading?
Okay. Because in forex trading and futures trading, or probably derivatives, you can make money when the price is going down. That's what we call shorting. If you short, let's say you shorten a price, you shorten the market at here. Let's say I enter a short here, and the price keep going down. I'm going to be making more money when the price is going down. It's more or less you're borrowing. I think that one is going to be on a different class where I get to explain what futures is all about, how you get to borrow money that you don't have. You're using the money you don't have to trade, something like that. That is basically futures and forex, right? So for futures, you can make money when the price is going down, and you can also make money when the price is going up. It now depends on the decision the decision you've already made. If you're longing, that is, if you're longing and the price keeps going up, it means you're going to be making profit if the price keeps going up. If you're shorting and the price keeps going down, it means you're going to be making more money when the price keeps going down. But if you're shorting and the price is rejected and start going up, then you're going to be losing. The same thing for if you're longing and the price keeps going down, you're going to be losing. So indication with this kind of candle is telling me that the price is going to keep going down. It might not go down and close below here, right? Okay, I'm going to redraw, or let me just clear this. Let's clear this. So I believe everybody understood what I just explained. So I'm going to continue from here. I'm going to draw a new candle beside this. So the implication of this candle is the price is going to go. The implication of this is that the price is going. This is our closing. These are open price. These are closing price. Then there's a potential of a market opening here. That is the candle. A new candle is going to open here. This is closing price, so it's meant to open here. And let's say the new candle now closed. We had. Let's have a week. Let's have a week. If we can even have a week below. Okay, now this is going to be a red candle, because the reason why it's going to be a red candle is because we have this is our opening price. This is our opening price. This is our closing price. This is our low, and this is our high for this candle. So that's the reason why it's going to be a red candle. Now, what am I trying to explain now? Because we already have this candle, this previous candle, this green candle, telling us that the pair are in control. What I'm going to do is open a short trade. I'm talking about futures right now. I'll open a short trade. I'm going to be shorting from between this region. Do we have a bracket here? I'm going to be opening a short trade, arrow, between here. Okay, it's already indicating that the price is going down. So opening a short trade around this region tells me the price is going to go lower. Now, how do you know the price is going to go much lower? That is the question. You're not really like, oh yeah, this indicates that the price is going to go lower, right? But this candle, if this candle did not close below this, now this is what we call engulfing, right? We can have, let me draw another candle just to be able to explain that better. So we have, if the new candle, now note what I'm going to do here, right? Now this is let's say this is a red candle or blue candle, or whichever one. It can either be a blue, can either be a bullish candle or a bearish candle. But if it's a bearish candle, or let's make it okay, let's keep it as bearish candle. And this is a bearish candle. Good. So this is our opening price. This is our, for this candle, this is our closing price. For this candle, this is our opening price. This is our closing price. Now, there's difference between this, the one on the left-hand side, these two candles and these two candles. Can somebody show me the difference between those candles, between these two? Not the length, it's not the color. Can you tell me what the difference is? Let me see if we have some pro traders actually here, or probably some advanced traders. Can somebody tell me the difference between these two? Just unmute and speak.
Okay, not like I know much, but I think this new example you just drew now, the red candle has a longer wick than the other one.
Okay. Yeah, it does, but there's still something I'm looking for. Agaze, I know you've been trading futures. Can you speak? These are opening, this closes. This is I. This is I2. This is low. This is low. So what's the difference between these two?
I wouldn't know.
Okay, good. Let me just explain. So this is how you get to know if the market is going to go downward or not. Now this is it. For the one on the left-hand side, we have an uptrend, we have this candle. Now, what the difference between the two here is this red candle, we already understand the fact that we have a longer wick here, indicating the price is going to keep going downward. And now the price keep going downward, and look at the close. This close engulfed the previous candle. It engulfed this previous low. That is, it closes below the previous low. That's for this one. This indicates that the bears are much in control of the market than the bulls. Okay? This actually gives you a higher chance that the price is going to go down, but it doesn't confirm it yet, right? It doesn't confirm it yet. I have a reason for it, but it gives you more like a 60% chance, more like 65, let me say 65% indicator that the price is going to keep going down. Or if you look at this one, we have the higher wick, that is the bears are in control. Or the next candle that opened the next day to this, the previous day, we have the candle, the wick at our lower price is lower than the previous low, but our closing price is not, the price did not close below the previous low. Look at what I'm saying here, right? This is the closing price. This is the previous low. The price did not close below the previous low. That is an indication that the bulls are already coming back to take over the market. So that actually puts it in the sense of the price, the next candle to open after this one could actually be a bullish candle. Like I said, it's a probability, but giving you a higher chance that the price is possible going to reverse because it did not close below this previous low. If the price actually engulfed, if it closed below the previous low, that's telling you the price is going to keep going downward. Whatever I'm explaining here, it also applies to uptrend. Okay, it also applies to uptrend. That is, if the reverse is the case. If we have, let's say we had a new candle now. let's say we have a new candle here that opened after this one. Come in, let me clear this. We have a new candle that opened after this one. This is what we call bullish engulfing. Okay, so this is our opening price, and also we can have a week here. We can either have a week or we don't have a week. It doesn't matter. We can also either have a week below or we don't have a week. It doesn't matter. Okay, so this is so that indicates that there's a probability that the price is going to keep going back upward. Though it did not fully engulf it, did not fully engulf this candle, but the body is longer than the wick or the shadow. So that's an indication that the next candle that will open will possibly, let's say, even open from here. The next candle that will open might actually open from here. I'm going to go to a chart to actually show you what we're talking about, right? So where's it? So you can have the new opening from here. Let me say he opens from here, right? And we have a wick. So reject a bit, then the candle can actually still keep going upward. So if I'm going to open now, the question is, where do I enter? How do I enter this trade? So when you have a closed, like if you have a candle closing around here, something closing around here, and it is closed around above the previous candle, but the body is longer than the wick, then there's a potential that there would be a potential trace back, a reversal, before the price keep going upward. So I want to enter my trade between the closing price and just a bit in between the previous closing price, the previous open price. That's between here and here. Is where I'm going to put my entry. So the price can actually come, eat my entry. If the price keep going up, eat it, and you can see the candle keep going upward. So let's go to live chart and explore what I'm trying to explain, right? Please, if you don't understand what I just explained, let me know so I can probably rephrase it. So
yeah, I can hear you, Shay.
Okay, good. So let's talk about what I explained the last time, which is if the price is going uptrend. Okay, we have something similar here. So this is an uptrend. The price is going upward, right? This is the peak of that market, right? The price is going upward. We have a bullish engulfing. This is the green candle. Can you see my screen, please? Let me know.
Yes, we can see your screen.
Good. So we had a bullish candle, right? And the next candle that opened here is what we call, like I said, is more or less an evening star. It's actually higher than the previous one. It's more or less an evening star right here. And we have the wick. It opens as a red. Having this one, like I said, at the top of the candle indicates a reversal, potential reversal. Okay, let me see if we can get one that has an hammer at the top. Coming an inverted hammer at the top, just to explain what I'm trying to. Okay, this is a green inverted hammer, but it's still okay. So right now, if you look at what happened, we have an uptrend. This is more like a doji. It's called a doji, but it's almost an hammer. A doji is when we have, this is a doji, when we have the price went up and came down, but the opening price and the close price are almost the same. That's what we call a doji. So we have a doji here. The price, this next candle This next candle tries to engulf it. But when we look at what happened, let me zoom in very well. Look at what happened. It did not close above this doji. It did not close above this, it closes below this premium. If you see, it went down as low as 47,500, but still closed at 53,900. But it opened at 57,000, at 57,700, thereabouts, right? So it closes below the previous candle. This is the daily time. Sorry, I had a break. Can you hear me? Can you see my screen? It closes below the previous candle. That indicated a price. If you look at what happened after that, it's a downtrend, massacre, as in a red blood, this thing, everything started going down. Have a look at what happened here. Now let's analyze this candle also. Looking at this candle, this is more or less a doji at the bottom of the downtrend. Now, if you look at the candle, the shadow is longer than the body. This shadow went long, it actually dropped longer than the body, right? But the next candle that opened next to this candle was a bullish engulfing. It opened and closed above this candle. It closed above this previous candle. And we look at what happened after it closing above this previous candle. Like I said, when it closes above this previous candle, there's a possibility for a potential reversal before an uptrend. When we look at what happened after that, it is an uptrend. You can see, look at the market direction. The price, we started having green candles, uptrend. Okay. So do you understand what I'm trying to explain here then? Or do you have any question?
Hello, Yashi, I can hear you.
Can you hear me?
Yes, I'm here.
So understand what I just explained?
Yes, I get you.
Okay, so do you have anybody having questions? Because we're almost at the end of the class, right? These are indications. Like when you see stuff like that happening, those are indications that actually help you tells you the direction of the market, if the price is going to go up or go down. So with that, the question is, where do I enter? How do I enter? Where do I enter? So the best thing is when you see a candle close, wait for a candle close before you enter. I mean, like, it's more or less an historical data, right? The chart actually has technical analysis is all about using historical data to predict what's going to happen in the future. So using your previous, the indication of your previous candle, whatever the previous candle is telling you, can help you project what the new candle is going to do.